The US is a net importer. We buy more than we sell. So when you have a cheap dollar, okay, a Boeing aircraft or General Electric wind turbine gets a little less expensive, but all the stuff we buy gets more expensive because we're paying for it in cheaper dollars. And that's what the central bankers really want. They want those price increases to feed through the supply chain and try to create inflation because governments around the world are desperate to get inflation. So that's the real reason they do it. And it can have a short-term impact. It can help exports a little bit. It can give you a little bit of lift. But the problem is it comes at the expense of the trading partners. This is just classic beggar thy neighbor devaluations. That's what currency wars are. So it can help individual country growth, but it does nothing for world growth. The world is no better off. One country is a little better off, another country is worse off. So the other metaphor I've used is, you've got 4 soldiers and they're fighting and it's a hot day and they get a break and they've got one canteen and they're all really thirsty. What do you do in that situation? You pass the canteen. In other words, everybody would like to drink the whole canteen, but you take a sip, you hand it to your mate, he takes a sip, and so forth. And that's the way the currency wars have gone. 2009 was the day of the cheap yuan. Remember, 2009, 2010, Secretary Geithner couldn't get out of bed without complaining about Chinese currency manipulation. 2011, the dollar hit an all-time low on a couple indices. That was the cheap dollar. 2013, along comes Abenomics, and one of his 3 hours was a cheap yen. All of a sudden, the yen's at 120, 124. Japan got a little bit of a lift. So who's suffering the whole time? Europe. Europe had the strong currency, 2 recessions in 4 years. So finally, 2015, it was Draghi's turn. Well, June 2014, they launched negative interest rates. In January 2015, they launched European QE.
Jim Rickards suggests that the global economy remains trapped in what he describes as depression growth. While it's not outright negative growth, it's well below historical trends, and there's no apparent escape from this cycle. According to him, we're witnessing shifts in major currencies, a stronger yen and euro, alongside a weaker dollar and yuan. He also highlights the pressure on Japan, noting that despite expectations of intervention in currency markets, global leaders like Jack Lew and Christine Lagarde have essentially told Japan, you've had your turn with a cheap yen, and you failed to implement necessary reforms. Now, the game has moved on. Rickards warns that there are only 2 outcomes to a currency war, either systemic reform or systemic collapse. He's skeptical of reform, citing a lack of political will and leadership. Unlike past figures like Keynes in 1944 or James Baker in 1985, he doesn't see anyone stepping up today. Without that leadership, he believes collapse is the most likely outcome. Reflecting on past crises, Rickards draws comparisons to events like the global financial crisis of 2008 and the Asian financial crisis of 1998. He notes that the latter, which culminated in the near collapse of long-term capital management, where he was general counsel, was equally severe but less understood. He emphasizes that bailouts often aren't about saving institutions, but about saving the broader system.
Yeah, no, Wall Street bailed itself out. I always say, hey, we owed on paper, we owed Wall Street $1 trillion in derivatives trades. If we had failed, meaning filed for bankruptcy, and we had a bankruptcy team ready to file those papers in the Cayman Islands because we were a Cayman fund, I said, I would have just slept in the next day. It's like, it's out of my head. We filed for bankruptcy, good luck getting your money. Wall Street bailed themselves out because they didn't want that $1 trillion of derivatives positions dumped on them. Then they would have to turn to the market and dump it. We were hours away from the closure of every major market in the world. It's not an exaggeration. Greenspan testified to that. Rubin said the same thing. It would have started in Tokyo, gone through London, ended up in New York. But every stock exchange, bond market in the world would have been shut down, at least temporarily, to deal with it. That's how bad it would have been. Lehman would have failed in '98. Forget about that. They were always the weakest link in the chain. It was easy to call in 2008 because they almost failed in '98. But the point is, okay, so we moved $4 billion in cash in about 3 days. If you think of it as a private deal, $4 billion all cash, no due diligence, wire the money. That's kind of how the sense of urgency. And so we filmed the runways. We brought it in for landing. The plane didn't crash or break up on the runway, but it was that close. So when 2008 came along, I just felt I was watching a movie I had already seen. It was like a rerun for me. And you're right, 2008 was even bigger, potentially more. We were, if not hours, maybe days away from the sequential collapse of every bank in the world, starting with Bear had already gone out. Fannie, Freddie, Lehman, AIG, Morgan Stanley would have been next, then Goldman, then
Merrill's
Citi,
would- yep.
et cetera. We were days away from that. And again, I think Andrew Sorkin did a good job in his book. So this isn't, we're not looking at strike two in a baseball metaphor, we're looking at strike three, because 98 was strike one, 2008 was strike two, now we're looking at strike three. The next one is going to be worse. So I think we've come extremely close. I think people are overly complacent. Just because we managed to pull off bailouts in the world didn't come to an end. Don't assume it wasn't close, and don't assume it won't happen again.
Sure,
But there's one very important difference. In 1998, Wall Street bailed out a hedge fund. In 2008, the central banks bailed out Wall Street. In 2018, let's say, keep up the 10-year tempo, who's going to bail out the central banks? And all we do is we move the problem to a different balance sheet. Now the problem is on the central bank balance sheet, because the Fed printed $3.4 trillion of new money since 2008. Their balance sheet was $800 billion. Now it's at $4.2 trillion, give or take, so $4 trillion of new money. But it's 9 years on.
Yeah.
They haven't normalized. If they had somehow got their balance sheet back to $800 billion, I'd say, okay, you guys could do that again. But you're at $4 trillion. What are you going to do when the next crisis hits, which could be soon, by the way? Go to $8 trillion, $12 trillion? Now, some people say, yeah, what's the problem? Just print more money. I have my doubts about that. But so who can bail out central banks? The answer is the IMF, because they have the only clean balance sheet left in the world. The Fed is leveraged about 113 to 1. With a duration mismatch. They look like a really bad hedge fund. And again, I've spoken to central bankers who say, well, who cares? Central banks don't need capital. A member of the Board of Governors of the Federal Reserve said that to me. She said, central banks don't need capital. I said, well, that's one point of view, but we'll see. Exactly, we'll see. But there's sort of an invisible, hard to define confidence boundary. And when you cross that confidence boundary, and every day citizens just wake up and say, you know what, I'm checking out of this system. You tell me it's all good, I don't believe you anymore. Yeah. And get me some gold because I know that the gold will be around, et cetera. That's an instantaneous loss of confidence in the dollars. That's what I mean by collapse. Now, just to be clear, I don't think we'll all be living in caves, eating canned goods, lighting fires with rocks and twigs. Life will go on, but it'll be different. The dollar will maybe be like the Mexican peso in the sense of being a local currency that you get when you go to the United States, but no longer the world currency. They'll try to bail it out with SDRs, the special drawing rights. If it works, if the SDR bailout works, it's only because nobody understands it, or like maybe there were 100 people in the world who really understand. I've spoken to PhD monetary economists, like people right in the field with PhDs from Harvard who can't give you a straight explanation of what an SDR is.
Jim Rickards paints a sobering picture of the future, emphasizing the vulnerabilities in the global financial system and the limited tools available to address them. The reliance on SDRs and the IMF highlights the desperation of central authorities to manage systemic collapse. However, the complexity and obscurity of SDRs might provoke public distrust, further eroding confidence in the system. The potential consequences include restricted access to personal funds, forced currency transitions, and the dollar's relegation from its dominant global role. While life would go on, it would be under a drastically altered economic landscape, with gold and tangible assets likely becoming the ultimate safe havens. This underscores the need for individuals and governments alike to reconsider their reliance on fiat currencies and prepare for a world of shifting financial paradigms.